How long do you think this can go on for until something breaks?
I don't think very long. I mean, you were saying that, is the Fed going to break markets? I think the answer is no. I think the markets are going to break the Fed. I mean, the way in which old stages in the market, like me, understand things is that you find the central bank can control things for a while, but eventually the market takes charge. And I think that's roughly what we're seeing. The Fed has a real problem, and that is with interest rates rising, and this is actually being forced on them by the markets. They're trying to sort of pretend they're still in control, but really, Chris, they're not. The problem is that if interest rates were to rise to the point whereby the loss of purchasing power of the dollar was reflected in the interest rates, then by then, all the malinvestments and even, government finances, the whole thing would just sort of fall apart completely. It would be catastrophic. So the Fed is desperate to try and get ahead of the curve before it goes much higher. So that, I think, is where they are. But there is another aspect of this, and that is that banks, commercial banks, are very highly leveraged, not so much in the United States, but if you look at Japan and the Eurozone, and also Switzerland and also the UK, the level of balance sheet leverage is enormous. The reason that it's so high in the Eurozone and Japan is that with negative interest rates, the lending margins have just got compressed and really compressed. So what does a bank do? It just expands its balance sheet to try and keep its bottom line looking reasonable. But of course, as soon as interest rates start rising, the whole game changes. And that is what they face now. So they are desperate to bring back, if you like, some sort of normality into their balance sheets, which means they've got to cut their asset side. And it's principally the asset side. What happens is when you cut the asset side, obviously the liability side cuts as well. So you find that deposits go down. And guess what? What is M2, M3? It is bank deposits. So you will see that contracting. And we're already seeing that beginning to happen. It's not all that visible because, the market as a whole is sort of split between financials and non-financials. And what we've had so far is the banks are leaning on their financial borrowers or borrowers who are dealing in financials to try and reduce their loan exposure. They've been doing that. They're now beginning to do the same thing for the non-financials. And if you look at loan officer surveys, you can see this. You can see, that it's all beginning to go pear-shaped. Now, I think the best way to understand the relationship between bank credit and the economy is to understand what GDP is. Every transaction, except at the retail level with small change, every transaction is all done in commercial bank credit. It's all settled in commercial bank credit. So if you get a contraction of commercial bank credit, then obviously you're going to see a contraction in GDP, nominal GDP we're talking. Now, at the same time as you've got a contraction in nominal GDP, you've got a high rate of price inflation, if you like, consumer price inflation, which really means that the real contraction is very, very severe. And this is the thing that is terrifying the Fed. And it gives them a problem. Do they protect the markets by trying to sit on interest rates and ensure they go no higher? Or do they let markets sort out everything and protect the currency? They can't do both. It's either or. I've been talking about this for about the last 2 years. I think it must have been a good 2 years ago when I started drawing a parallel between what John Law did in France in 1720 and the current situation. Now, where are we today? We've had the same situation. the Fed is in the position of John Law. Do they actually support the shares? In other words, the current, the financial assets, the government stock. Do they run in and do that? Do they do more QE, which is effectively what John Law was doing, to try and keep the market going? Or do they support the currency? And that is the problem that the Fed now faces. They are no longer in control. Now, we know which way this is going to go. We know that the Fed has no mandate to create the massive unemployment and the stock market crash of a complete reorganization, letting the market say, we're going to sort this out, and just sort of pray that the markets, if you can sort of protect the currency, the markets will come back, as they always have done in the past when government hasn't intervened. But they don't have the mandate to do that. And think of the effects on the government budget deficit, with rising unemployment and falling taxes, increased welfare commitments. I mean, you think you've seen some, monetary inflation so far? No way. There's nothing compared with what's down the road. So that, I think, is the basic problem that the Fed faces. They are no longer in control, but they have a choice. And they can either go and support the markets and destroy the currency, or support the currency and destroy the markets.